Good afternoon. I'm Tracy Gordon, Acting Director of the Urban Brookings Tax Policy Center. It's my pleasure to welcome you today to this year's Donald C. Lubick Symposium. Our topic is, can the Internal Revenue Service administer a complicated tax system on its budget? We're fortunate to have an excellent keynote conversation followed by a panel of speakers, which is also excellent, to address these important topics. First, before turning things over to our honoree, Donald Lubick, I'd like to do a little bit of housekeeping. Our event is going to be recorded and the recording will be posted online afterward. All participants will be muted. The speaker biographies are also available online. You can hide captions or adjust settings using the live transcript button at the bottom of your screen. And please type any questions or comments into the Q&A box at any time. And be sure to include your name and organization with your questions. So it's my pleasure to introduce Don Lubick, our honoree today. Don Lubick has served presidents from Kennedy to Obama, and he has helped to improve tax policy in places from the city of Buffalo, New York, to the Dominican Republic and Eastern Europe. He was a protege of Stanley Surrey, who is an idol of all of us in the tax community, and helped to build Treasury's Office of Tax Policy into the vital resource that it is today. His work has always emphasized equity, efficiency, and simplicity in the tax code. And we are thrilled at the Tax Policy Center to be able to host this event and to continue pursuing these topics with him. Don, thanks very much for being with us today.
I am honored to be present at another symposium on the most vital taxation issues in our country, represented on all sides by the outstanding taxation experts in the country. All of us who participate in the field of taxation are grateful to the Urban Institute and Brookings Institution for this tradition. For many years, the Internal Revenue Service auditors have diminished in numbers to the detriment of needed national revenues. We are now pleased to hear from experts to deal with this issue.
Hi, I'm Eric Toder with the Tax Policy Center. First, want to thank Don Lubick for all his contributions to tax policy, and he was a great person to work with. I had privilege to serve with him both during the Carter and Clinton administrations, and we really appreciate his friendship to us at the Tax Policy Center as well. It's also my privilege to introduce Judge Maurice Foley, the Chief Judge of the United States Tax Court. Maurice, before joining the tax court, was a deputy tax legislative counsel in the U.S. Treasury's Office of Tax Policy Center, and had been before that had a number of positions, including tax counsel for the United States Senate Committee on Finance. Judge Foley was appointed to the court by President Clinton in April 1995 and reappointed by Barack Obama in 2011, and he's been elected and reelected as Chief Judge. It was my privilege to work with Judge Foley during my time in the Clinton Treasury also. So I will now turn it over to you.
Thank you, Eric. And it's certainly my pleasure to be here. Thanks to the Urban Institute, and I feel very much at home here with so many folks who have extensive government experience, but few can match the government experience of Don Lubick, and I'm particularly honored to speak at a symposium that is named after him and in honor of him. All of those who have been fortunate enough to work in the field of tax in the federal government at either the IRS, the Treasury Department, joint tax, Ways and Means, or finance, you all know how much of a blessing it is to be involved in the process. But you also know that most people don't know what you do, and that includes family members. I remember I have a brother who is a tax accountant, and I would keep him informed as I worked through different government jobs. And I had some advance notice before I was going to be nominated to the court, and he was one of the first people I called and told him that, you know, the president would be nominating me to the tax court soon. And his response was classic. He paused for a few seconds, and then he said, "Well, you started your career at the IRS, where you worked on generation skipping transfer tax regulations that very few people cared about and nobody could understand. And then you left there and you worked at the Senate Finance Committee, and you continued to make our tax laws indecipherable." And he said, "Finally, you might have a job where the family won't be ashamed of you." So that's the words of encouragement from a loving big brother. I was intent on making sure that my kids understood the importance of my job. And I remember before I was sworn in, the clerk of the tax court gave my 5-year-old son a little wooden mallet, and he was attached to that mallet. He took it around everywhere we went. He carried it. And I remember one day we were in the line in the grocery store, and he was holding the mallet, and the lady in front of us turned around and kind of kneeled down and into his face and said, "Hello, young man, what are you going to do with that mallet? Are you going to break up crabs tonight?" And he said, "No." And she said, "Well, what are you going to do with it?" And he says, "I'm going to be a tax court judge." And the look on that lady's face when he said that was a look of horror and dismay. And if there were cell phones at the time, I'm sure her next call would have been to Family Protective Services, because she looked at me. She said, "Why did he say that?" And I just shrugged and walked out of the store. But suffice it to say that all of us tax people are a little bit odd, and you might even say a little strange. Tax nerds may be a little strange, but just because the tax law is sometimes incomprehensible, that doesn't mean that the process for adjudicating your tax dispute has to be incomprehensible. So I'd like to talk to you a little bit about the tax court and how we do our work and how we strive to make it simpler for taxpayers. We're in the administration of justice business, and we're always seeking ways to make things easier, simpler, to arrive at the right result. Now, the tax court is at the end of a very long road. There's legislation, there's regulations that have to be developed, there's forms that are developed, and then there's transactions that are entered into and reported on those forms and sent to the Internal Revenue Service, where the returns are audited. There's the appeals process, and then at the end of the road, there's litigation. And I want to talk to you a little bit about what happens at the end of the road. There are 3 forms for litigating your federal tax dispute: claims court, district court, and the tax court. Well, the tax court is the only federal court that has prepayment jurisdiction. So in other words, if you go to claims court or district court, you have to pay the tax liability and sue for a refund. In the tax court, you can have your case looked at by the judge and adjudicated before there's any obligation to pay or not to pay. Now, over 96% of all tax cases go to the tax court. Now, we might like to believe that the reason why they go there is because there are all these tax experts on the bench in the tax court. But the fact that you don't have to pay the liability before going to tax court is a major reason why the tax court gets the bulk of all tax litigation. Indeed, while we don't have a Judge Wapner on the court, I think it's fair to say that the tax court is certainly the people's court. And everybody who's under age 50 will not understand the Judge Wapner reference. But just a little bit about the tax court. We have spaces for 19 judges who serve 15-year terms. And we have a unique statutory mandate to hold trials and resolve disputes with as little inconvenience and expense to taxpayers as is practicable. As a result of that mandate, while we're based in Washington, D.C., we travel all around the country to hear cases. We travel to 74 different cities. And most of those cities, we go at least one time to those cities on our list. Now, while the IRS may issue 2 to 3 million statutory notices of deficiency each year, only a small fraction of those are litigated. And our courts, can we pull up the first slide? The court's caseload varies from year to year based on changes in jurisdiction, based on the level of the IRS audit activity and enforcement activities, and also based on which forum a taxpayer decides to litigate his dispute. But this is a chart that delineates the cases filed and cases closed from 2016 to 2020. And as you can see, the average of cases filed is right around 25,000. And we typically close more cases than are filed. You look at FY 2020, and you can see that there's a noticeable drop. Only approximately 17,000 cases filed. And of course, that is directly attributable to the pandemic. We go to a second chart, please. Now, start off with a couple million notices of deficiency. We end up with a little over 20,000 cases that are filed at the tax court, and then most of those cases are going to settle. So in a classic example of that is 2020. Now, the numbers in 2020, as I stated earlier, are a bit low, but as you can see here, we had a total of 128 cases that went to trial. 110 of them were in person and 18 were remote. It gives you an idea of what that funnel looks like. Starts off very, very broad and it narrows down to a very, very limited number of cases that actually go to trial. All right, you can remove that slide. The district courts and claim courts typically have less than 1,000 cases per year. So the bulk of the cases go to the tax court. And year after year, we typically average about $20 billion in dispute. When you add up all of the notices of deficiency that are before us, it's typically in excess of 20 billion. I'll note that a small percentage of those cases, probably less than 1%, have more than $10 million in dispute. And while there's just a small fraction, those large cases are just a small fraction of our total cases. They account for approximately 80% of the total amount in dispute for all of our cases. And you contrast that with the claims court and the district court, and they have much smaller amounts when you add up the totals for the amounts, the total amount in dispute that's litigated in those courts. Now, as all of you know, the tax law is horribly complex, but we don't believe that the process for adjudicating your tax dispute has to be complex. And our rules reflect that. In the tax court, there are special rules for cases that are where there's less than $50,000 in dispute. A taxpayer in these cases can elect to be treated his case treated as a small tax case. As a small tax case, the taxpayer is subject to much simpler procedural rules and requirements. And in addition, the standard rules of evidence are relaxed in these cases. These simplified procedures make it much easier for taxpayers to present their case, and these procedures are helpful for taxpayers who don't have a lawyer. 90% of the people of the taxpayers who elect small tax case treatment do not have lawyers. They represent themselves. Now, if a taxpayer elects small tax treatment, while there are many advantages, there are also some requirements that they have to accept. That if they elect small tax treatment, neither the government nor the taxpayer can appeal that case. Now, most of the people who come to the tax court, they're one-time visitors. They're not frequent flyers. So we try and make it as easy as possible for these folks who may only come to the court once in their life. Typically, these small tax cases are short. They last less than an hour or two, and they're not like some of our regular cases, which can last, days, weeks, and sometimes months. In FY 2020, about 7,000 taxpayers elected small tax case treatment, and these so-called S cases were approximately 35% of the total cases that were before the court. Now, while the S cases represent 35% of our total cases, they represent less than 1% of the total amount of dollars in dispute. And if you please could pull up the next chart. The remaining 10,000 cases, or 65% of our total, are regular cases. And this group of cases consists of all cases that are not eligible for S case treatment, and some cases that are eligible for small tax case treatment, but the taxpayer has chosen not to make the election. So what types of cases come to the tax court? And this is a chart that reflects the types of cases that we dealt with in fiscal year 2020. And as you can see, the bulk of those cases are deficiency cases, and it can be anything from a small businessman who is having his mileage deduction expenses challenged, to a major corporation with a large transfer pricing case, or a very, very large estate tax case. There are lien and levy cases, which represent about 4.5%, where a taxpayer is able to come to the tax court to under circumstances where the IRS has proposed a lien or a levy. Whistleblower cases, we have this is where the taxpayer has filed a claim with the whistleblower's office, and they're challenging the result of filing that claim. And we also have some new jurisdiction, passport cases. Those are fairly new, and then we have other areas of jurisdiction that reflect a much smaller percentage of our work. As I mentioned earlier, we start with a large number of cases that are filed, but we have very few cases, relatively few cases actually come to trial. Now, that doesn't mean that tax court judges are sitting on their hands. The tax court judges are working even those cases that don't go to trial. There's a lot of work that takes place even before a case is settled. There are motions, and there are conference calls, and there's a lot of work for many of the cases that aren't reflected in these numbers that you see. One critical thing about the tax court is that most of the taxpayers who come before us do not have counsel. They do not have a taxpayer, an attorney representing them. In fact, 75% of our cases are brought by taxpayers representing themselves. Now, this conference touches on complexity. And one thing I like to emphasize to folks is, well, maybe not with this audience, but to the average person, the tax law is not intuitive. If for some reason your intuition lines up with the Internal Revenue Code, you're probably a very unusual person. And you might perhaps need to be under a doctor's care and medication, because it's very unusual that someone's intuition lines up with the Internal Revenue Code. But if you happen to be one of these disturbed individuals, there is a place for you, and you will feel very comfortable, as I did, at the Office of Tax Policy, where you find kindred spirits. And I can tell that joke because I did work there. Well, the bottom line is that assistance from someone familiar with the process and the legal requirements can demystify the process and make things go smoother. And there are a variety of ways that we have established or that are established that allow taxpayers to get assistance when they come to tax court. Self-represented taxpayers, particularly low-income taxpayers, have a variety of options. They can get help from one of the many low-income taxpayer clinics that are established throughout the United States. There are 128 low-income taxpayer clinics throughout the United States, and there's at least one that services each of the cities that we go to. In addition to that, there are some folks who don't meet the low-income requirements that the low-income tax clinics must adhere to. There are calendar call programs where local bar associations have put their heads together, and they have attorneys from law firms who volunteer their services to provide assistance to taxpayers who are going through the litigation process. Now, the coronavirus pandemic provided many challenges for the court, but it also provided some opportunities. Last year, we had to quickly pivot from a paper-based enterprise to a fully remote and electronically capable organization. In doing all of this, one of the things that drove us is to make sure that we could continue to do our work, continue to serve the public, and continue to do it in a way that was safe. So we did a lot of things. We during the pandemic, we updated our website so that it could be more mobile friendly, and we had been working for several years on a new case management system to replace the case management system that we had from the 1980s. So we launched Dawson, our new case management system, and it couldn't have come online at a better time. It's a web-based and mobile-friendly case management system, and it's readily accessible from everywhere. Many taxpayers like it because it has an interface that's modern and easy to use, and it's especially helpful to our litigants who only come to the court once. In addition, petitions can be filed electronically with our new system, and we're not reliant on paper. The system is constantly being worked on. So we're using open source code to develop it, and we use an agile development method that allows our software engineers to continually make changes and add functionality as issues and problems arise. Well, not only do our engineers have to be agile and flexible and ready to adjust to change circumstances, the court had to be agile and ready to adjust to changed circumstances. because when we found out we couldn't do in-person hearings, we had to quickly pivot to an alternative. And that alternative was remote trial sessions. In fiscal year 2020, we originally planned to have 230 weeks of trial sessions, but we ended up with only 149. And 10 of those trial sessions were remote. The COVID cases started to show up in early 2020. And in March, we had our last week of in-person trial sessions, and we began to cancel our spring sessions. In all, we had to cancel 81 trial sessions involving 4,400 cases. Yet after pivoting to remote sessions, we were able to continue to do our business and to keep the cases moving. So last spring and last summer, we worked to implement remote proceedings. And while they're not in-person proceedings, they worked well and have allowed us to continue to fulfill our mission. Fortunately, we were uniquely positioned for remote sessions. We don't have criminal matters. We don't have juries. That makes things a lot easier. In addition, the tax court is known for its stipulation process, where the IRS and the taxpayers work before a case actually goes to trial to narrow the issues and to agree to as many of the facts as possible, so that when the case finally arrives at trial, there's no need to go over some of the more mundane routine issues that sometimes have to be established at trial. We use the ZoomGov platform, which allowed us to maintain our accessibility, and it was also relatively easy to use for taxpayers. People were familiar with it, and users can during the remote proceedings, they can attend hearings and trials by their computer, smartphone, tablet, and even their regular telephone. So we made it possible for people to have their day in court, even if they couldn't leave their house because they had childcare issues or other reasons. Instances where people were under travel restrictions. So the remote proceedings allowed us to fulfill our mandate to hold hearings and trials with as little inconvenience and expense as possible. Even some taxpayers who are on the road all the time, truck drivers, for example, who may not have a fixed location as they travel, do long haul travel across country. They have a available forum with remote proceedings. Many of our trial procedures were modified to accommodate these proceedings. And one of the more important changes is that judges have been getting involved in the cases earlier than normal. And there's a fairly widespread use of pretrial conference calls and Zoom calls. The one advantage of the remote trials is that we had to find a way to provide public access. So for our trials, and we have public access through YouTube on the court's website. So someone can, if you're a tax court junkie, you can get up in the morning and listen to a trial session in New York, and that afternoon you can tune into a trial session in Chicago, and later on that afternoon you could tune into a trial session in Los Angeles. But I must say, if you're spending your days that way, you're probably in need of a good hobby. Perhaps take up yoga or golf. You're going to need a life. But the fact is, we have expanded the number of people who can listen in and learn a little something about how the tax court operates and how our system of adjudicating tax disputes operates. Well, as the court gradually resumes in-person proceedings, some changes made as a result of the pandemic will continue. The court's future operations will incorporate remote proceedings. They provide cost savings and expand access to a justice. They reduce travel costs and expense to witnesses and parties, and they make it easier for folks who have difficulty taking time off. In addition to reducing the travel expenses of the court, They provide a less intimidating setting for taxpayers and provide greater access to legal assistance for volunteers and clinics. The judges have greater flexibility in working with taxpayers in scheduling certain cases using the remote proceedings. There are many instances where we go to a city once a year: Anchorage, Alaska, Jackson, Mississippi, Billings, Montana, Aberdeen, South Dakota. Typically cases we go once a year, but with the use of the option of remote proceedings, we can have more flexibility in when we schedule those sessions. Well, 20 years ago in 2001, then Chief Judge Wells gave a speech at Chapman University entitled "Challenges Facing the Tax Court in the New Millennium." And in this speech, he presciently predicted that someday in the distant future, the tax court would be filing documents electronically and adjudicating cases remotely over the internet. Well, I guess the future is now. I went back and read that speech, and he didn't say anything about a global pandemic, but at least he got a couple things right. And while the pandemic has presented many challenges, it's provided opportunities. And I know the subject of this conference is, can the Internal Revenue Service administer a complicated tax system on its budget? Well, I'm not going to opine on that. I'm not qualified to opine on that. But I can assure you that the tax court, with its budget, will continue to modernize operations, fulfill its mission to administer justice, and continue to make our court more accessible, more user-friendly, and more efficient. Thank you.
Well, thank you very much, Maurice. That was an extremely interesting presentation. Unfortunately, we really don't have time for questions. Maybe that was your intent, but whatever. There are a few questions, so maybe I can forward them to you later if you don't mind.
All right, thank you.
Okay. Thank you again. It's my pleasure to introduce Janet Holtsplat, who will be the moderator for the upcoming session. Janet is a senior fellow at the Tax Policy Center, and she has a long and distinguished career at the Treasury Department and the Congressional Budget Office, where she worked mostly on issues such as earned income credit and healthcare involving low-income taxpayers. But she's now turning her attention to high-income taxpayers. And so with no further ado, I'll turn it over to Janet.
Thank you, Eric. You kind of summed up my introduction by saying that I used to work on poor people, and now I'm working on big corporations as of the past 2 weeks. And thank you, Judge Foley, for your insightful, as always, comments about a portion of tax administration that most of us really hear about, at least those of us who work in government on policy. And also, I do want to give a special thanks to Don, who I worked for during the Clinton years at Treasury. You were a great teacher for those of us working in the trenches. As many of you know, over the past year or so, there's been a surprising outpouring of support, and support by some very high-level people, former secretaries of Treasury and IRS commissioners, for an increase in funding for the IRS. This is coming after years of deep cuts to the budget. And that culminated last week in a paragraph on page 24 of the president's plan to rebuild the US infrastructure, in which he proposed an increase in the IRS budget to beef up tax enforcement of corporations. Of course, none of these proposals are altruistic. Their goal is to use more money, to give the IRS more money, to get back even more money in return. Today's panel will discuss how the IRS and taxpayers have fared under cuts to the IRS budget over the past decade. We're very fortunate to have the right people here to discuss these issues. Doug O'Donnell joined the IRS as a revenue agent in 1986. Since then, he's risen up the ranks, tackling many of the challenging areas of the tax code. Today, he is the commissioner of the Large Business and International Division. That's the division of the IRS that deals with corporations and partnerships with over $10 million in assets. His division also has responsibility for monitoring the global high wealthy individuals. Sharon Katz-Perlman is another veteran with over 2 decades of experience dealing with disputes between the IRS and taxpayers. Currently, she serves as KMPG's international head of global tax dispute resolution, advising clients from every stage of the process, from prior to filing through exams, appeals, and any other procedures to resolve disputes. Jeff Hoops is an associate professor in the Keenan Flagler Business School at the University of North Carolina. He also serves as the research director of UNC's Tax Center. Jeff has conducted research on the impact of audits on corporations' compliance. And then we have Aaron Towery, who's an associate professor and KMPG faculty fellow at the University of Georgia's George Terry College of Business. She's also an academic consultant for the Research Analysis and Statistics Division at the IRS. She is the co-author of a study that was released a couple of years ago that got a lot of media attention, and where they examined the impact of the IRS budget cuts on its selection of audits and on collections. Before turning to the panel discussion, a housekeeping reminder: please submit questions for the panelists through the Q&A function here. And for the benefit of the moderator, me, who has trouble multitasking in these kinds of events, please keep the format of the question simple, though the substance can be complex. And in exchange, we are committed to keeping the use of the IRS acronyms to a minimum. So let's start off discussing the magnitude of the problem, the non-compliance and the IRS resources to combat it. The last IRS study of tax compliance covered the years 2011 through 2013. Overall, before late payments and IRS enforcement actions, the IRS was estimated to not be collecting about $441 billion in federal taxes. That amount dropped to $381 billion, or about 14% of the total amount owed. The study also found that about 14% of corporate income tax was not voluntarily paid by businesses on time. After accounting for late payments and the IRS enforcement actions, that non-compliance rate fell to about 11%. The study also found that about 11% of income from partnerships and S-corps were not reported on individual income tax returns. So, Doug, how reliable are these measures? How useful are they for developing your activities in your division?
Yeah, I'll stay away from commenting on how reliable they are and leave that to the statisticians. I think that's their expertise. But what I would say is that it does inform where we should be applying our resources, but it's a much broader, this is a part of the conversation where it's a little bit outside of my remit in terms of what I do, but it does inform where we apply resources.
There is a gray area, though, between avoidance and evasion. And that seems to be an area that doesn't get really covered in the IRS compliance studies. So we'll be getting more into that issue. In the Annual Appropriations Acts, Congress determines a level of funding for the entire IRS and allocates that total across 4 different accounts, including customer service and enforcement. It's left up for the IRS to allocate those amounts across the IRS divisions. Not accounting for the additional funding for the recent COVID legislation, the appropriations for the IRS in total have been cut by 23% since 2010. The enforcement account, the largest share of the IRS's budget, has taken the deepest cuts with funding falling by about 26%. What share of the IRS's budget goes to, let me phrase it, what share of the IRS's enforcement budget goes to large business and large business and international division?
The large business and international division gets about 16% of the enforcement budget. It varies a little bit, but typically that's the range where it is in the total, 16%.
And has that changed over the past decade?
No, it's relatively constant. I mean, there's some variations. When we're looking at how the enforcement funds are going to be allocated across the agency, we do take a look at the existing staffing, and typically what happens is that there's a hold on hiring, and the different attrition rates will drive where some of the cuts are made. So in LB&I, our attrition rate runs about 7 to 8% per year. So typically, if there's a reduced funding or it's static, we'll kind of hold at no additional add to the size of the footprint. But it does vary from year to year as to how it gets allocated, but it's pretty close in terms of the 16%.
So that really that's interesting. So we haven't seen a drop in terms of your funding relative to the other divisions then?
That's correct. I think the best way to put it is that we've all had a downward attrition or a downward level of personnel across the enforcement side of the house, whether it's criminal investigation, small business, self-employed, tax-exempt government entities, and wage and investment. We've all seen a similar type of reduction in our footprint.
So overall, during this period in the last decade, we've seen the audit rate fall from about 0.9% in 2010 to 0.4% in 2019. But for corporations in your division with over $10 million in asset, the audit rate fell from about 17% to 6% in that period. And for the biggest corporations, those with 20 billion or more in assets, the audit rates fell from nearly 100% to about 50%. With less funding for audits, how has your division changed its compliance strategies toward large corporations and partnerships?
Yeah, so maybe an opening comment just to sort of set the stage. The coverage rate, no surprise, it's made up of the number of audits that we conduct, and it's compared to the number of returns that are filed. And so during this period of time where we've had reduced funding and so fewer people conducting audits, the filing of returns that we had to cover in the large business area grew. This is especially the case for partnerships. So it's in our annual data book so everyone can see this, but I think it's an important point to start with. I'll touch on a couple of different areas. First, in 2017, we began to shift our view away from selecting returns for audit and going to look more closely at issues, and we called this our campaign model. We started working on this in 2016 and actually implemented it in 17. And the idea was to move in this direction to improve the deployment of the few people that we did have. We had, we could see that we were limited in the number of examiners available, and we wanted to make sure that we put those individuals on the returns where we thought the non-compliance risk was greatest. This effort was led by our subject matter practice areas, who gathered information from the workforce to identify areas where we thought there was going to be or potentially was non-compliance. We did best, and we do best in the campaigns where the information that we're using to identify the risk is reported on a return in a fairly discrete manner. The more we're taking a line item and we're having to understand the risk of a return relative to that item, looking across a filing population, the less confidence we have that we are going to be able to identify the issue specifically. We're making improvements in that area. I'd say that the Tax Cuts and Jobs Act, and I'm following your admonition to stay away from acronyms, that was enacted in 2017, disrupted us a little bit as we had to pivot into this new environment where we have very little experience in terms of what it is that taxpayers may be up to. So we started a special campaign for TCJA. We began last summer, and the idea behind it is to put taxpayer returns into the audit pipeline with a very large support network and an ask that the examiners look as broadly as they can so that we can begin to understand better what taxpayers have done to respond to this new environment. Do they have new transactions? Have they made structural changes? How are they actually coping with this change? Are there differences in the way that they're accounting for issues? Have they recharacterized items? All of this information we're collecting as real time as possible so that we can have a better understanding of the response to the change. And the idea would be to improve specific issue selection going forward, but also to inform our statistical models that we use to select work. There's a couple of other significant areas that we have in the division. One, well, there's two that are pretty closely related. One is the old Coordinated Industry Case, or CIC program, which was a real-time audit, which was a continuous audit program that has been around for 30 plus years. And it was a front-end loaded program where we identified taxpayers who were of a certain size and complexity, and we would put them under examination. Over time, we've been able to get to fewer of them, and we realized that we needed to do a better job in identifying the taxpayers that we would apply resources to in this environment. So we've moved to what we call the Large Corporate Compliance Program. We have to have an acronym, it's LCC, it's not shocking. LCC uses a set of variables that are similar to what CIC used to score a return for size or complexity that puts them into the population of those taxpayers that would be in the program. CIC used to have about 1,000 taxpayers in it. When we moved to the LCC program, part of what we ensured is that the variables that drove the score that put the taxpayer in that pool were from information that we could get systemically. And so what we've done is we developed a systemic scoring as opposed to an audit team scoring that looks across the enterprise. And we identified about 2,500 taxpayers that are in this pool. It was a bit of a surprise to us because it was 2.5 times what was in the the CIC program, and they, at least nominally, were the same. But it turns out that the scoring that we were looking at across the system indicated something different. LCC is also different in that it's not a continuous audit program. We're bucketing taxpayers into a high risk, a medium risk, and another risk category. And we're using information from past audits to identify the taxpayers that we think are high risk, and then using a statistical model across the enterprise to identify the taxpayer risk based on those high risk returns. So it's a bit of that group of high risk returns drive what we think is high risk across our population. We're able to get to 100% of the high risk returns. So there's about 170 in that population, but we are not able to get to most of the medium risk and very few of the other. I should make a quick point here. The other risk is not identified as low risk. It's just that those returns don't look like the returns that are in the high risk bucket. We've not been able to get to them in any numbers, so we're not really sure what's there. And we're less certain about what is in that population, frankly, all of the LCC population following TCJA. So there's a lot of learning that we're expecting to do in the coming years as we learn more about how taxpayers have responded to this changed environment. Yeah, I think at this point I'll stop, Janet. But those are two big programs that we have focusing on dealing with a large corporate environment in LB&I.
So is there a fundamental difference in the kinds of, like the size of the corporations and the types of businesses that would be covered by the campaigns versus those covered by the large corporate, the LCC, which I said I wouldn't do the acronym?
Typically, the campaigns are focused on the smaller returns. Some of those issues are identified in the very large, but the majority of the campaign issues do fall out in the smaller entity returns. We have a number of the campaigns that are focused on individuals because we cover not just the high wealth, but also the international individual returns. But what we're really trying to do with the larger returns, because there's such a consolidation of their operations across a global enterprise that it becomes very difficult to identify the specific item on the return that you'd want to look at by just looking at the return. Our audit teams typically spend 25% of the total audit plan on planning what the audit is going to be. And that requires a lot of digging into the return itself, any sort of information that may be available in our systems, financial reporting that's available. There's a deep dive that goes into identifying the specific items that we want to look at. So the larger, more consolidated an entity is, the more difficult it is for us to identify a specific item to look at. We can identify risk, the sense of relatively where a taxpayer falls out in an ordering, but it's difficult for us to say for sure which issues are the ones where there is a risk of non-compliance.
So with respect to the campaigns, I can see the benefit of it in terms of, narrowing down the issues and helping taxpayers with some issues that may be somewhat confusing. But does it also cue the taxpayers to the areas that the IRS is the areas for which the IRS is most paying attention to, and cue them to move into other areas that may be potentially advantageous to them in terms of non-compliance?
2 points there. Understood. Two points there. First off, that a taxpayer should not think that we are only going to examine campaign issues. So while we would focus on campaigns, it's very likely, especially on the large corporates, that we'll be looking at many other issues on the tax return. We also thought, and we've heard the same from externals, that flagging up the items that we're worried about and describing what it is that we're worried about with respect to those items has an impact in terms of the independent auditors paying attention to what it is that we're worried about and making sure that taxpayers are compliant with the rules. So there is some bump in compliance there. We can't measure it. We're not sure of what it is, but it may be a deterrent effect, or it may be that individuals or entities are more aware of it and are more likely to comply. But we're willing to take that risk, because we think it's important for taxpayers to understand what our view is on an issue and that we're going to be looking at it more closely. One other sort of point here is that we are required, when we provide instruction to examiners, to make that available to the public. So we think it's very important that as we're thinking about a particular issue and how we're going to approach it, putting it out to taxpayers, to representatives, we think is helpful in them understanding how we will approach them and how we're going to deal with an issue. But again, just because it's not a campaign doesn't mean we're not going to look at it. Many of the issues that we look at in transfer pricing and some of the items that we look at in the partnership arena are not campaigns at all, because we know what we're worried about, but we know we also cannot find them in the data that's with a file return. At least not currently. If we improve our skills, or if there are people that are listening to this panel and they want to join us and help us improve our detection, we'd be happy to have them help us out.
I just wanted to expand on something that Doug was saying. I mean, you asked the question, Janet, as if warning taxpayers about what the IRS is going to be looking at was negative. I think in a lot of cases there can be a positive effect. Like Doug said, there is basically this deterrent effect, right? Most of what the IRS does, or most of the impact that the IRS has, is not because they audit, it's because people are afraid of getting audited, and they comply with the law because there is that deterrent effect of an audit. So if the IRS says we're going to examine really, really closely the research and experimentation credit this in the coming years, then you're likely going to get more accurate preparation of that credit. Now, I mean, it certainly could be the case that you file a tax return that looks as if the credit is more, appropriately calculated, but it really isn't. I think in reality, like the deterrent effect is a real thing. It's a positive thing, not necessarily a negative thing that you're letting taxpayers know what you're concerned about.
Sharon, how is this affecting your, how has this changed the advice, and how is it changing your interactions with the IRS with these new approaches that have come up?
Really, for the larger taxpayers, and that's really where I spend almost all of my time, the campaigns have not really had that much of an impact. And as Doug said, sort of the traditional audit may be scaled down a bit because the risk assessment process is much better than it was, 20 years ago, 10 years ago even. But the audit process itself for a major multinational continues with a specific focus on a lot of these issues. So 965 is a major campaign area for the service where we are seeing a lot of activity. The TCJA.
For us.
Sorry?
Could you explain?
Sorry, the repatriation provisions from the TCJA that just came in. A very, very big area for the service and for taxpayers. And so that is a campaign that we are seeing popping up a lot. The overall focus that Doug explained in this TCJA campaign, which is really a very different kind of campaign. The other campaigns are an identified issue. That campaign is, as Doug said, more of an information gathering opportunity so that the service can learn how provisions of the Tax Act were implemented on the return. So kind of a much broader approach. The issue with the campaigns and what we are seeing across a number of companies is that it's a very coherent approach to looking at an issue. There is a uniform approach. A lot of the requests for information are the same. And so there is an ability to understand, I think, better what it is that the service is going to be looking for, prepare in a more efficient manner for the responses. And that process, I think, has been helped along to a certain extent. But the overall exam process for a large company is not limited to these campaigns. And so, continues as it did in the past, as I said before, with a better focus, and you see the impact of the risk assessment. It's not as broad-based.
Do you want to comment on how changes in the partnership regime have also changed perhaps your interactions with the IRS?
The partnership area is a newly expanding area. There is a new act, the Bipartisan Budget Act, or the BBA. So can I use BBA?
Yeah, you can.
Find my, okay.
You're allowed.
Okay.
We'll make an exception.
The BBA has changed things, I think, a great deal for the IRS, and I think it's a very positive change for the IRS. Prior to the BBA, the governing statute, and I'm going to use the acronym only because I'm Tax Equity and Fiscal Responsibility Act of, I think it was 83, it might have been 82. 82, Doug is giving me the two. Or TEFRA, was the first effort to have a statute that assisted the service in examining partnerships. And TEFRA was a good start because there was one examination at the partnership level. The issue with TEFRA is that when it came down to collecting the actual tax, the IRS was in a very difficult position of having to go and try and collect the tax at the partner level. And that got much more complicated as the partnership structures got more complicated, and there were tiered partnerships, and the service actually at one point had a campaign on TEFRA linkage cases to make sure that the cases were properly coordinated behind the scenes at the service center so that they were processed correctly and the tax could be properly collected. That has changed now. And so now with this new act, the BBA, the process now permits the service to conduct its examination and collect the tax at that level, at the partnership level. Very, very different situation for the service to be in, and a much better place for them to be in terms of collecting the tax and moving forward with enforcement. We are just starting to see those cases bubble through the system. There are not a lot of BBA examinations that have started. There are some in the works, but it's a whole new set of rules, and it will change. I think the way that partnerships are audited, an area of sort of historic, very low, I would say low focus area for the service. And now it has absolutely been elevated. There will be a lot of activity there.
So with all these new approaches, what are the plans in terms of evaluating the effectiveness of them, and particularly their effectiveness compared to the traditional, the older ways of doing that?
I'll start. What we do is part of the upfront work in a campaign is to describe what the objective of the effort will be. And so if taxpayers are not filing a certain form or a schedule, we'd expect to see more of them filed. If they're not reporting an item, we expect that item to be reported. Or if there's what we term an over deduction or an over claiming of a credit, we'd expect that to change. So where there's a line item that we can follow through, we'll measure the change in the filing. Some of our campaigns have been very much focused on writing to taxpayers to let them know that we see something that we want to make sure that they're aware of us seeing it, sharing with them what our view of the law is, and then giving them an opportunity to correct through an amended return. So we're able to track whether taxpayers respond to that. Okay. I think the broader challenge we're beginning to work through is with the large corporate compliance program, for example, where the very largest taxpayers who do pay the most amount of tax in the corporate environment are, we can begin to see what are some of the very macro level metrics that we would expect from that type of a program. And you can look at the total dollars, the hours spent, the months it takes, how long our people take to work through these examinations, and whether or not we're doing we appear to be more efficient, more effective. I personally realized that the change to the LCC, the Large Corporate Compliance Program, and the enactment of the Tax Cuts and Jobs Act has put us into an interesting, the timing was almost within the same year. We did not know the tax reform was going to happen the way that it did. And so that has disrupted our model, and we're very interested in working to quickly update whatever it is that we learn from our TCJA campaign into our scoring model to help us improve our identification. But again, a lot of the work in that very large space, the large corporate space, is the very broad issues that are hard to find on the discrete line item, and it is very much dependent upon our employees giving us real-time feedback and letting us know the types of issues that they see that they're running into, so that we don't have to wait for the examination to get all the way through Judge Foley's approach, right, where they got to go all the way through litigation. We're trying to get more real time with that.
So if, as an evaluator, as a researcher, I've been struck by, if I were evaluating this, I would be looking at the no change rate. And there was a study that came out from Treasury Inspector General for Tax Administration, which I will now refer to as TIGTA, that looked at no change rates for audits of large corporations that had been identified through data analysis. And it found no change rates at about 50%. Now, no change rate, for people not familiar in the term here, is for when an audit is done and the taxpayer is able to substantiate everything on the return. So now this is all before your new approaches have taken into place. But what factors have gone into these high no change rates, which are substantially higher than we would find, say, for individual tax returns? What explains those high no change rates? Is it because Sharon's such a great lawyer? You just nod now.
no comment on Sharon's lawyering, but what I'd say is that we had seen the increase of the no change rate, which is counterintuitive. We were conducting fewer audits, and one would have thought that our no change rate would have dropped, but that was not the case. We don't agree with the no change rate that TIGTA came up with, but our argument would be it's not 50, it's closer to 40% for that DAS work. And I'd argue that's not good. It needs to be much lower. We should be deploying our resources against returns where there is non-compliance. We can't say for sure what it is that drove the no change rate. We could see it start to pick up in the 2007, 8, 9 period, and then it definitely increased more in the more recent years, the more recent 6 or 7 years. We did a survey of our workforce to understand better what it is that they think is part of the problem. And the variation on the responses suggested to me and to the team that there was no one thing that we could point to. But here's what we've done as a result of it. We're moving to limit the amount of DAS work that we put into the audit pipeline because we think that model is not an appropriate one to select a large quantity of work. Apologies for the background noise. There's a siren here. We're moving to reduce the amount of DAS work that we do. We've updated the DAS model to improve its reliability. Again, it does work through a look back, and there's a question in my mind as to how useful it is with TCJA having been enacted. We are moving away from, and this gets to part of what employees point out was a challenge. We're moving away from work that is assigned only to you if it's near where you work. This geographic proximity issue creates a problem for us in areas where there's not a lot of businesses. And our people start working on examinations where if the return were in a much bigger city, say a Manhattan or Chicago, we would never have looked at it. So we're trying to make sure that we pick returns across the country that are risk-based as opposed to geographic-based. That is a very significant change. COVID-19 has forced this issue in ways we didn't contemplate. So that's helping us move in that direction. And we're also moving to improve our ability to identify issues with data analytics and get away from these statistical scoring models that we're a little bit leery of. We just haven't had a great deal of luck with them of late in this sort of mid-sized corporate environment. So we're keeping a very close eye on what happens in the large corporate compliance program, because it does use a statistical model. And so while we don't have a large number of those returns under examination, we're paying very close attention to what the results are because of our experience with that. So the point is that we're changing to try to get away from DAS, and we'll continue to work on models that can help us assess risk of the return while looking to identify issues specifically that we could work on or examine.
Janet, if I can jump in for a second, I think another thing that's important to think about with all of these questions is that when the rate was cut from 35% to 21% for corporations, that probably changed a lot of incentives for these corporate taxpayers. So I think a lot of the tax planning that you saw before the Tax Cuts and Jobs Act was in response to the fact that we had a higher corporate tax rate than most other jurisdictions in the world. And so now that that rate is 21%, I think it's important that when you're looking at these no change rates, that could also, if you see that there's not a big change in these no change rates, it could just be driven by the fact that corporations aren't engaging in as much aggressive tax planning because the rate is so much lower. So I think that's something to think about as we go forward, that the incentives for these corporations have changed. And to something that Sharon mentioned with, one of the campaigns is on the toll charge, the 985 adjustment. I think a lot of companies right now are still just trying to interpret some of these very complex provisions of the TCJA. And some of them are very complex on their own. But then when you look at the interaction between the different provisions, it gets even more complex. And so I think some of these campaigns aren't necessarily going to be, some of the campaigns are obviously intended to find non-compliance, but I think at least there's probably going to be an increasing number of campaigns that are just trying to identify
confusion and making sure that taxpayers are properly interpreting the law.
So when we change the law again in the next year, will we just see a lot of issues dealing with confusion or changes in incentives?
Well, what's fascinating is, if the law gets changed, corporations still will have to file tax returns under the old law. That will be audited under the old law. They'll still be issuing regulations for the old law because those audits will continue to go forward. And so we'll be determining two sets of simultaneous regulations, one for the old system, one for the new system. I mean, in reality, what a lot of firms want, I think, is just a consistent and kind of constant tax system that isn't changing so much. And this is part of the problem with statistical modeling is the way this works at the IRS is you come up with a model based on a really deep understanding of tax returns and what you might get out of them if you audit them. But that takes a long time for the IRS to do. I mean, there's a reason the NRP was done last, like from 2011 to 2013. It takes a long time and it's very costly to do. So you build this model, the tax law can change several times, but you're still using this model based upon data that's now years old, and tax incentives change. I mean, like Aaron said, the tax rate will change, new provisions will get added, other provisions will go away, they'll expire. And so taxpayers are going to be changing. The models can't change because you built the model on this old data. Taxpayers will change, and the models will get less useful the more the tax law changes. I mean, of the many costs that are constantly changing tax law has with every kind of new administration comes in, one is the inability to use historical data and statistical models from the IRS.
Yes. Sorry, Sharon.
Yeah, I just to add to that, I mean, this issue of the changing tax law and guidance coming out, a couple of years after the statute is enacted, and then there's proposed regs and final regs come out, and those regs are different from the proposed regs, maybe not a lot, but enough to create some discrepancy or difference in an approach. And then now, Janet, as you said, the law is likely to change again, and what does that mean, and how does a taxpayer catch up? Sort of at an intellectual level, this is very difficult and fascinating things to debate. At a practical level, for a taxpayer that is trying to manage this and all the changes in the law and make sure that the return that's being filed is correct at that point in time based on the existing statutes and guidance, when changes are already underway and the taxpayer knows that the next return is going to be different. If you start with that and then add to it what the IRS has to deal with in terms of understanding the existing law and the fact that this is what they're dealing with for this year, but next year or 2 years down the road, it's going to be completely different. And the IRS has to be able to adjust and deal with it as well. I mean, from a practical sense, this is just really, really difficult for everyone to manage. And so it makes me wonder then, Jeff, to your point, just about these models and the statistics and what, sort of the real meaning and usefulness of all that in the face of all of these constant changes. And then just one other thing, because I just want to, and I'm going to go back and I apologize, the distinction that I think I made and want to be sure that I made between the TEFRA statute and the BBA for the IRS is that the collection now of the tax is done at the partnership level. That's the benefit. They don't have to chase all the partners. And I believe that's what I said, but I just want to be sure that I was clear on it. And that's why I think that area is going to expand. But anyway.
So I want to turn quickly to going forward. As I said, there are all of these proposals out there to increase IRS funding. I'm going to exempt Doug from the next question, understanding the politics of our lives. But for the rest of you, if the IRS got an infusion of new funding and it was applied to enforcement as is in the president's plan, what would be the best use of that funding? Should we? Yeah, Jeff?
I don't have a kind of specific suggestions, but I would, my basic intuition would be to let people like Doug and the other people who actually work at the IRS decide, and not to have politicians decide. I think that the incentives of the politicians are not those that will get like the most optimal allocation of resources.
So for example, some of the legislation out there would set specific targets for the percent of corporations, percent of individuals at certain income ranges for them to be audited. Would that be
I mean,
You would not
or
advise that?
If you're a politician, it really doesn't look good to say, we need to expand auditing of like mid-sized businesses. Turns out they evade a lot of taxes because there's a lot of cash involved, and that might not actually be where there's some return, but it doesn't look good. Instead, you're going to target kind of the areas that look politically, good to target, and that's again why I would put those allocation decisions not necessarily in the hands of legislators.
I would vote for training budget, and I agree that the decision should be made by the people at the IRS, but well-trained agents are critical to the process, not just for the IRS, but for the taxpayer. And the taxpayer really appreciates dealing with agents that are well-trained, technically strong, and understand these very, very difficult issues. It's hard to go to an examination when it's not clear that the examiner completely understands the issue. And so I would vote for putting some of that to training, additional training.
Yeah, just to add to that, in addition to the training, I think hiring some of these people who have been working with these new provisions in practice, because bringing that knowledge into the IRS would be so helpful. Because like I said, I've been to multiple symposia where I've seen practitioners discussing how they've been trying to interpret these new provisions like the GILTI and the BEAT and the interest deductibility limitation. And they have such a rich knowledge of this. And so if there was some way for them to bring some of that into the IRS. And the second thing I would say in terms of just technology, I know all of the big four, Sharon can speak more to this, but I think all of the big four have made huge investments in technology to model all of these different provisions. And so it seems to me, I think the IRS would need at least something equivalent to that kind of investment. And Sharon, like I said, I know it's a huge amount of money that the firms are putting into this. And so I don't know, it seems like the IRS would need a similar level of resources to implement something similar.
So in a way, part of those resources maybe would be for salary bumps to bring in people from the private sector who otherwise might not want to take a big hit in terms of their income.
Yes, I mean, I think, I'm not sure what the statistics are, but I know that there are people that leave the IRS to go into practice. And I don't know that salary is the sole factor, but I think, yeah, a salary bump would potentially help the IRS bring in some of these people from practice that have this rich institutional knowledge.
So, I mean,
Going on, actually, I mean, the service has been, and I don't know, Doug, if you're comfortable talking in this, I would imagine you are, but the service has been bringing people in from industry, and especially in the partnership area, there was a whole initiative underway to bring in people with expertise in that area.
Yeah, I'll just come in for a second here. I mean, we do aim in LV&I to hire mid-career professionals. It's correct, Aaron, that the salary is less here than you could find in a firm, in a consulting firm or for a taxpayer. But the work-life balance turns out to work for a number of people. And some people are just interested in giving back. And so our division, LV&I, has about 20% of our current workforce has joined the government in the last 18 months. And the majority of them that joined are mid-career. We have very few that are recent graduates. We have like 70 that are recent college graduates. So of the 4,700 I have, the majority of those that are new come from, outside mid-career. So we're pretty successful. The issue for us has been that we don't have enough budget to recruit large numbers of people in. I think if we had that, we could get more people to join the agency. And you're right, we do aim for the expertise that we need. Sharon's right, we had a big effort to focus on the large partnership arena. It's something the commissioner is very interested in. It's something that we've been talking a lot about. And we moved in that space, but the numbers are in the 50 to 60 people range. And the number of those returns that we've examined is in the 600 range, where it used to be around 2,200 10 years ago. But the filings are nearly 60% higher now than they were 10 years ago. So, I mean, when I talked earlier about our coverage rates, we have this sort of dynamic of growing filings and reduced people available to work them. I mean, it really affects what we can get to.
So I have a budget type related question. So as I say, there are these proposals to put in more money. Appropriations tend to be on a yearly basis. But if you were to get the money and you were to put it in terms of both staffing, which has taken a huge hit over the course of the decade partly because of budget cuts and partly because of a hiring freeze. But if you put the money into hiring and put the money into further work in data and analytics, which requires more perhaps money in terms of computers, what's the time span? How long does it take to hire and train people? It helps if you're getting mid-career people. How long does it take to develop the kinds of modeling to get you to a point where you can introduce a new program?
On the modeling side, we've been working very closely with the folks in the RAS, the Research Advanced Analytics and Statistics area, to test some artificial intelligence. We're running some AI experiments on understanding whether we can move past a statistical model that looks at historical data and is able to identify non-compliance now. So we've got some of those experiments underway. Having more people that have expertise in that space would definitely help us. And I'd say that in terms of the hiring and training, if we get mid-career professionals in and they're working in the area that they specialized in when they were on the outside, they can contribute significantly within a year to a year and a half. They have to get accustomed to our culture and our mission and the fact that we run the audit, we request the information. There's some controversy and some confrontation that people may not be accustomed to. If we're talking about a recent graduate, it takes them some time to just get the tax law expertise, maybe 3 or 4 years before they're really, strong in all areas of tax law you'd want them to work on. And frankly, they're probably at the 5 to 6 years before they can contribute in some of the more complicated areas with international tax planning and some of the more sophisticated structuring that we see with multi-tiered entities. So it really does depend on the type of work and the individual. But again, mid-career, super help to us.
Okay, I'm going to ask one more question and then move quickly to the audience questions. So in terms of proposals out there by Larry Summers and by Charles Rosati, they call for increases in the IRS budget, and then they have, which would go to audits, it would go to infrastructure, it would go to information reporting. They get very large, from my perspective, returns on that investment. In Summers' work, it's about a 10 to 1. Rosati has rates of return going from 16 to $33 for each additional dollar of investment. Aaron, you've looked at, in your research, you've looked at how much money was lost when the IRS reduced audits. Do these rates of returns on investment that are being talked about, do they seem right?
Oh, that's a great question. The first thing I will say is that in my study, or in our study, we specifically look at large audits of public corporations. And so I don't know that our ROI necessarily translates into what those estimates were, because they're obviously looking at the broad range of taxpayers. But one thing that I want to point out with respect to increasing the budget is that going back to something that Doug mentioned earlier in terms of kind of having these high risk, medium risk, and low risk. I mean, those are obviously relative designations. But one thing that we find in our study when the IRS has fewer resources is that they audit fewer returns, they propose fewer deficiencies. But we do find that of the deficiencies they propose, when they have fewer resources, they're able to collect more of those. And so that's consistent with what Doug was mentioning in terms of when they have fewer resources, they're trying to do the best with what they can. And so they're really targeting those high risk taxpayers, but there's a lot of medium and low risk taxpayers that probably should be audited, but there aren't enough resources to audit them. And so I think our evidence is very consistent with what Doug was mentioning earlier, in that it's only allowing them to go after a certain subset of taxpayers when the resources are limited.
So we have a question from Jonathan Lubick, relationship to Don Lubick. He says, no large multinational likes controversy. The ability of large multinationals to get pre-rulings, APAs, etc., or wealthy individuals to get such rulings in their eyes is overly protracted and complicated. His understanding is that an agreement can take 2 to 3 years, regardless of how complicated the case is. Is there a way to simplify this process and thereby also reduce the IRS costs and also get better compliance, a 3-goal process here? Doug, Sharon, comments on this?
I'll start and Sharon will come in and talk about her experience, I'm sure. But we are currently in the process of working in a multilateral environment, trying to streamline the APA process, which is where governments get together and agree on how we're going to price cross-border activities, services, goods, et cetera. They do take a very long time. There is a significant amount of economic analysis involved. And there's also a bit of a controversy between the two governments as to where the income is going to be lodged and who's going to be able to tax it. It is not a simple matter. I've been involved in a number of them and they do take a lot of effort, but there's got to be a way for us to do them more quickly, especially when we have some of the same taxpayers coming back in. These typically are for a 5-year term. They're typically coming back in to re-up. And it's not clear to me that we're able to do them in less time the second or third time that we're going through it. So there's an opportunity, in my view, to streamline, to improve, and we need to keep focusing on it. And yeah, I mean, we'll continue to drive that.
I would just add to that, that absolutely, for a multinational taxpayer, the majority of their time now is often spent dealing with these cross-border transactions and trying to get certainty more efficiently and earlier. And the APA process, and the A in APA, the first A stands for advance. And to Doug's point, I mean, Doug was leading a meeting at a conference that I attended of the Forum on Tax Administration, and somebody stood up and said the goal should be to get advanced. Let's put the A back in APA and get that, because it's quite right. I mean, it is a great process if it works in a timely fashion. And there is a lot of work going on now to try and do that. And it is an excellent process, but it's difficult because, as Doug said, there are 2 governments involved, at least. And so this is a negotiation where the governments have to agree. And that is a process in and of itself, let alone just sort of APA structure.
I want to ask one last question, which comes from the audience. It comes from Jim Wetzler, former tax official in New York and JCT. He writes, I think recent years have seen a big reduction in penalties assessed on corporations and a big increase in the percentage of additional tax recommended by auditors that is agreed to by corporate taxpayers. Is this correct? His view of penalties going down, additional tax recommended going up?
The additional taxes being recommended is not up. It's actually way down. It is correct, though, that LB&I does not assert penalties in the manner that, for example, small business asserts penalties. The difference is that typically the taxpayers that we're working with are well advised and they've considered their positions very carefully. They frequently have a position for what they've done, and they've reported in such a way that they flagged it for us so that we know it's there and that they've got some penalty protection. So it's a different environment. There's a lot of opportunities for taxpayers to make known to us what they've done to prevent the additional penalty on any deficiency that may come about.
Should penalties be increased? And that's my last question. Aaron and Jeff, from your view as researchers, do penalties matter?
I guess in my experience from talking with people in practice, it seems like a lot of the tax planning that goes on right now is legal tax planning. It's just aggressive tax planning. So I think there has been a shift. You know, I think Sharon mentioned something about, you know, the reputational costs of something being outright fraud or outright evasion. I think what we're seeing is that a lot of these big corporations, I mean, engaging in legal tax planning. And so the issue of penalties is a little bit unclear when you're talking about tax avoidance versus tax evasion. And so I think part of my answer is that I think it depends on, whether this is, evasion or avoidance. And my sense is that it's more avoidance, which might be one of the reasons why penalties might be going down.
All right, and now we are at 1:32, and I'd like to convene you for a second session to go through the rest of my questions and the audience questions, but sadly I can't. I thank you so much for your participation. This has been really helpful for me as I'm learning about this, and I hope it's been helpful to the audience. So thank you all for being here, and thank the audience for all 152 people who remain out of 250 who attended. I thank you all for being here. So bye.
Thank you, Janet.
Thank you.